It's basically more than doubled from those levels. 42 points on the Nifty, 18,200. Mahesh Nandurkar is now joining us. He's India strategist at Jefferies. Mahesh, great to have you with us here. Thank you very much for your time. First up, in case we don't say it later, Happy New Year to you, your family, your team, from all of us here at CNBC TV18. Mahesh, how are things looking as we head into 2023? In a way, not a consensus, but expectations this time as we begin this new year are muted. Yesterday we had Nilesh Shah from Kotak who said that bond returns and equity returns perhaps should get closer, not converge, but should get substantially closer into 23. What's your sense?
First of all, thanks a lot, and best wishes to you and your team as well. Yeah, you're right. We're beginning the year. Actually, this actually reminds me very much, about the beginning of the year 2022 as well. The markets were more or less at similar levels, and were looking expensive. Today, markets are not looking that expensive, by the way, right? Because 1 year down, we've seen earnings growth catching up by about 10, 12%, 13%. And the markets are, where it was about a year ago. So, in that sense, we've seen some moderation in the valuations. I would say that to a large extent, one of the biggest worries of CY22 has played out, which is that of rising interest rates globally, as well as in India. And while we can argue about whether the Fed, ends at 5% or 5.25 or 5.5, but we are essentially talking about 25, 50 basis points here and there. Large bulk of the rate hikes, I would say 80% of the rate hikes in the current cycle are now behind us. And the same thing, is true with India as well. So, the normal worry about the rates going up, usually impacting the market P and the stock P multiples, a large part of that, that rate hike worries are now behind us. So I would actually say that, yes, the global, slowdown clouds are much more stronger today, but the rate hike worries are behind. So it's now looking like, a buy on dips kind of a market to me. Yes, you're right. We are not likely to see, runaway returns, but so was the case in the last 12 months as well. And I would say maybe, what you mentioned, looks right, that maybe over the next 12 months or so, the fixed income and the equities will probably give similar kind of returns on an overall basis.
Okay, so you're saying that this is a buy on dips market for you right now?
Yes, absolutely. Because, I believe that from the current levels, maybe the upside is about, let's say, 5-7% from a 12-month perspective.
Okay.
But if you were to get, some dips, then, the expected returns will go up.
All right, that's good to hear. Starting the interview on an optimistic note and perhaps ending the year on an optimistic note as well. Mahesh, good morning. In the year gone by, the two spaces that did the best were metals, which went up, I think, about 20%, and banks, of course. Banks has become a bit of an overcrowded trade, don't you think? And what about metals? Do you think these two pockets will continue to outperform in the year to come?
Yeah, banks has definitely been an overcrowded trade. Both the foreign institutional investors as well as the domestic investors are significantly overweight, on this space. And that's why we are seeing the investors are now willing to go down the curve in terms of the valuations, and there's a search for, where the valuations are looking more attractive. But by the way, while the trade is overcrowded, most of the leading banks, the private sector banks, are not, overvalued or not expensive, so to speak. In fact, if you look at the historical valuation comparison, many of the large private sector banks are trading at a discount to the historical, PE or PB multiples. So it's not looking that expensive, as such, going by the last 10-year history, etc. But you're right. And because of that overcrowded trade, the investors are going down the curve in terms of the multiples and maybe willing to compromise somewhat on the quality as well. And, in that context, and also in the context of where the NPL cycle is, PSU banks are looking like, a good bet. Historically, the investors have looked at only some of the large state-owned banks, but I think there is an reasonable outlook from for the mid-cap PSU banks as well. So that's one space, on the banking side. So, we remain positive, there. On metals, yes, I mean, we have actually been, quite negative underweight, on this theme for most part of the year. We've seen a rally over the last 2 to 3 months. But the rally that we've seen in Indian stocks is actually still much lower than what we've seen elsewhere in the world. And the reason for that was the domestic metal prices were at a significant premium, steel prices significant premium to the international landed prices. But that premium has now shrunk. So that's one positive news. The second positive news is the China reopening, right? And despite what has happened post the reopening and the COVID outbreak, etc., the news from the Chinese government in terms of the opening up of the economy seems to be, very, very unidirectional. And that's a positive, that's one more positive news for the metals outlook. So yes, I would say that it, makes sense to be at least neutral, if not overweight on metals as well.
All right, neutral on metals and banks. People are going down the value curve as well. But the place to be in this morning, Mahesh, is the IT pack. The Nifty IT index is virtually at the highs of today's trading session. In fact, the move started from noon yesterday. And now that's percolating down to the mid-cap IT stocks as well. So among the top 5 F&O gainers, you have 3 of them belonging to the mid-cap IT pack. Intellect Design at the high point. We have Coforge, which is showing some gains as well. Emphasis and Persistent. All of them are spiking as we speak. IT was a serious underperformer last year. A lot of people believe that by virtue of its own underperformance, it makes it an easy bet this year. Would you back that view?
I have come across this view, myself as well, but we don't think we are there just as yet. Because while the sector has underperformed, but if you look at the valuation, they are still significantly higher. And the second point that I think is that while the margin-related risks are now well priced in, my belief is that the potential revenue disappointments are not priced in well. We haven't really seen any revenue downgrades as such, and my sense is that when the budgets for CY23 gets firmed up from the US corporates, we will probably begin to see a slightly softer mood and some revisions on the downside. So my sense is that it's too early to jump into the IT sector. I would still keep it as an underweight. And one of the big sort of thing that we are looking out for is the hiring trend. We have seen a significant slowdown in the hiring by the large IT companies. In fact, the latest data that we have, which is for September quarter, we saw the September quarter hiring was actually at almost like a 8-9 quarter low, and in fact lower than the pre-pandemic September quarter as well. So in that sense, what the managements are effectively telling us through the hiring decisions is that the outlook is somewhat uncertain. So I would not jump into the IT names just as yet.
Okay, so you wouldn't jump into the IT names just as yet, and PSU banks are looking like a good bet for you. Where else are you going to put money in, Mahesh, this year? There's been some really good pockets, whether it's defense has come back in a big way, capital goods, infrastructure is what everyone is talking about now. Even the bankers were telling us that corporate capex is back in a big way. What are the pockets that you like?
Yeah, you're right. Industrial segment, is looking good. And one of our favorite sectors, real estate, last year was a relatively bad year in terms of the stock price movement. So mind you, bad only from the stock price movement perspective, but the fundamental data points, whether in terms of the new pre-sales, project launches, etc., has been very, very encouraging. And I continue to believe that the higher mortgage rates will not come in the way of the property cycle recovery that we've been witnessing now for the last 2 years. We are just about going to be entering the third year. And I think it's going to be a multi-year upcycle. And while the fundamentals have continued to surprise on the positive, the stock prices have not, because investors, especially the global investors, have this perception that higher rates, higher mortgage rates, higher interest rates is bad for property sector. And while that's true globally, that's not true in India, and we've seen it. But now, as the rate cycle is close to peaking out, I believe the investor interest will come back into that space. So property sector, the developers, space is a small sector, but looking, it's looking very, very interesting to me, especially given the fact that the stocks have also pulled back reasonably well.
All right. Mahesh, stay with us. I want to now put out some data and I want your kind of view, want your opinion on this. This is, the market laser segment that we sort of put out for you a little later than usual. We usually try and do it before markets open. Let me sort of point to this sort of data on the wall. As you can see, what this data shows you is the last 7 years. 2022, of course, the clock is still ticking on 2022, so the number could change. But for the year, we are up in rupee terms 5%. Go back and look at the returns all the way from 2016. This is the 7th straight year of gains. If we end with, anything over 0%, in the positive, it's the 7th straight year of gains, and we're up 5%, right? 2016, we started at 8,000 levels. The closing that year was 8,000. From 8,000, we are at 18,000 over the last 7 years. Now, why is this important, and why are we putting this out? This has never happened before. I went back and looked at the 32 years that Nifty has been trading all the way from 1991, and we've never had a clean 7-year consecutive run on the Nifty. This is the longest stretch that we have. The previous kind of stretch that we had was between 2002 and 2007. But those were 6 years, right? 2002 is when roughly the bull market started. It kind of extended all the way till the global financial crisis of 2007, 2008. That was a 6-year stretch. In the 32-year history, that was the longest, and now this tops that, the 7-year stretch that we just kind of pointed that out. What are we trying to say here with this data? Nothing profound, nothing, no deep analysis, but simply this, that when you hear people say that 2022 has been tough, yes, it has been tough. Remember this, that, it's outperformed. 2022 in India has outperformed the world by a margin. And number two, there is the 7-year sort of history as well. Continuous, never before seen positive returns. Now, cycles, right? Now this is not a cycle that's happening for the first time, but, this is sometimes a simple but powerful way to analyze things. Now, I'm not saying that 2023 has to be poor or anything, but just keep in mind that given the backdrop, the 8,000 to 18,000 journey, 7 straight years of returns, and with the tough global backdrop, it's not going to be a clean one-way kind of move. Expect a sort of a turbulence, expect some moderation in expectations, some moderation in returns that you should be absolutely fine with. So, just a quick piece there that I wanted to put out. Mahesh, I don't know if you have any thoughts on this, if you looked at these kind of numbers, but if you do, please do share your views.
Yeah, I definitely have thoughts on this. You're absolutely right in pointing out that last 6-7 years have been extraordinary, and we've seen pretty decent returns. And last year has been particularly fantastic from Indian stock market point of view. All the global markets, including the developed markets, have corrected. Even the S&P for the year, I think, if not mistaken, is down about 12-13%. From the peak, it's down even more. And India has withstood quite well. Now, going into CY23, I think we have to obviously keep in mind the global backdrop as well. I think there are two things that I want to point out from a global standpoint, which should be positive for Indian markets in general. One, we are looking at, as I mentioned, the rates, the US dollar rates, Fed rate peaking out sometime in 1Q, CY23, and which basically should mean that the US dollar strength should also peak out. In fact, we've already seen the DXY has corrected by about 8-9%. But I think the theme for CY23 will be dollar strength peaking out, which is usually a good news for the EM currencies and EM markets, because when the dollar sort of peaks out, we see some money flow coming into the emerging markets. That's point number one. Point number two is the China opening, right? And what is really interesting is that despite such a massive COVID outbreak, the government is pretty keen on opening up, and there are more and more positive news flows coming out. I think that's also a positive news for EM markets, because that's ultimately the largest EM market, and if that is going to attract investor attention, then the EM as an asset class actually sees some flows. So because of these two reasons, I believe that India has the risk of underperformance definitely going into CY23. But for somebody who's looking at Indian markets alone, we are not worried about whether we underperform S&P or global markets or Chinese market, etc. We have to look at what happens in India on an absolute basis. And I think if the EM markets are going to see inflows, India will see its share of flows, may not necessarily in line with what India's weight is. Maybe, as I said, India might end up underperforming. But the tailwind is that of foreign flows being on the positive side than on the negative side, which was the case in CY22. And I believe that if the foreign flows keep on coming in, the domestic flows, I don't see why it should turn meaningfully negative in any way. So that's the reason why I think it's a buy on dips kind of a market. And looking at the December 23 target of around 19,000, which is just about 5-6% higher. But yes, therefore I'm calling it for a buy on dips kind of a market.
Yeah, no, I mean, a dip raises return potential. And that point about EMs attracting money and we getting our 15-16%, which is the weight in the MSCI Emerging Market Index, I think is well made. Mahesh, thank you very much. The point that was very simple, just to kind of temper expectations, right? I mean, as Infosys used to do, guide lower and beat expectations. That's a much more pleasurable outcome as compared to, vying for higher and higher returns and then coming up short. So that was the entire point. Thanks very much, Mahesh. It's a pleasure. Happy New Year from all of us here once again, and we'll see you in the new year. On that Nifty return, sort of that for the last 7 years, I'll take that point forward later at 4:30 p.m. on the editors' roundtable. I will put some more data along with that 7-year number that we kind of highlighted just right now. So that's coming up at 4:30 post-market hours on editors' roundtable. But we've got our first management on the show joining us now. I think Century Plyboards, guys.
Absolutely. Before that, just want to point out that the mid-cap index is seeing a good run-up this morning. So almost a 220-point gain on the mid-cap index. And a lot of banks are moving around. So you have Punjab and Sind Bank, Bank of Maharashtra, IOB, RBL Bank, all the smaller banks that were perhaps beaten down last year. The mid-cap banks are looking pretty good this morning. But let's do one thing. Let us move on now and talk about Century Plyboard itself. Keshav Bhajanka, the Executive Director at Century Plyboards, joins us now to discuss demand trends, the outlook for the business and how the new